Joining us now is Ken Bensten. He's the president and CEO of SIFMA, and you can go to SIFMA.org, and SIFMA is Invested in America. It's the voice of the nation's security industry, and they advocate for effective and efficient capital markets, which we're getting now. And Ken Bensten with us. Hey, Ken, great to have you on the John Fredericks Radio Network.
Yes, good morning. Thank you for having me.
Ken, let's talk a little bit about capital markets. And one of the things that the Trump tax cut did that has gone completely under the mainstream fake news legacy media enterprise is the amount of capital that the tax cut brought back that was parked overseas because they had that time period where companies could bring the money back into the U.S. without the repressive taxes, repatriation, if you will. What type of an impact has that had, Ken?
Well, first of all, it was an important measure, no doubt, and there was a however you want to describe it, a quirk in the tax law or whatever that would disincentivize companies to repatriate dollars that they didn't otherwise need for their overseas operations. And we don't know yet. I mean, it takes time to get that kind of data, but the intent of doing this certainly made sense because you really want to promote investment, and what investment means in the U.S. is capital formation. That means investing in plant and equipment, software, technology, and that, creating more economic activity gets to the point you made on your intro of creating more jobs. So that's certainly the right direction. It'll take time to see the data, but the right direction of reinvesting in the U.S. economy.
What about the 1-year write-off, right? Instead of having to amortize capital investment over a 5-year period. And people don't realize this effect, people think of writing amortization and writing off a capital investment. They think of you build a new factory, you buy a bunch of new machinery that's millions of dollars. They don't realize how much this affects small businesses, Ken, with capital formation. Because if you're able to go out and buy a new printer, if you're printing, for instance, I own radio companies, to go out, buy new computers, new equipment, microphones and stuff. Doesn't seem big, but the fact that you're able to take that write-off in the same time you're purchasing it, that's a big deal that, again, nobody really understands how impactful that's been for the economy. Am I right?
Yeah, no question. I mean, it incentivizes owners to go and purchase plant and equipment, like you say, and those are big purchases that you need to run your company, that your employees need to conduct do their jobs, and the ability to charge that off more quickly certainly incentivizes sort of pulling that forward and making that investment. So it definitely has an impact.
Ken, why is the stock market sustained itself at these high levels? Even 6 months, 12 months ago, everybody was waiting for the readjustment, for the down spiral to come. A couple times we had a few bad days, and Dow Jones and the Wall Street Journal were blaming the trade policies of the president and telling us stock Armageddon was coming. Why has the stock market been able to maintain its status now for such an extended period of time, in your view?
Yeah, and this is my view. I'm not an analyst, so I don't give it financial advice or whatever. But I think if you look at the data and you look at what a lot of the market analysts have been saying is what's been going on in the broad economy is continued earnings growth, and that's what really drives sort of long-term market performance is earnings growth. So you have certainly fluctuations that occur either based upon market perceptions or even market realities. And, I think one of the things that's really beneficial about getting through these trade discussions and getting to a final USMCA and this phase one of the of an agreement with China, that in many respects can add fuel to the market where there's markets see some stability on a forward-looking basis in terms of investment decisions they want to make based upon how they where they see they're going to be able to sell their product or manufacture products. So I think in the immediate term, it's been because earnings growth has just been strong with a core group of U.S. companies that are listed in the U.S. And then ideally followed on finalizing USMCA, so that settles any issues with respect to NAFTA. We have a new agreement that's an updated agreement that creates a lot of certainty for firms that are affected by that in the broader economy. And then this Phase 1 China deal adds certainty on what the forward-looking path is for our relationship with China, which is an important, it's a strategic relationship for sure, but it's also an important economic relationship.
We're with Ken Bensten. He's the president and CEO of SIFMA, which is one of the biggest firms in advocacy for the nation's securities industry. One thing, Ken, I want you to elaborate on. The president talks a lot about, in economics, liquidity and how important that is in a thriving economy in a growth state like ours. Can you elaborate on that?
Well, I think the liquidity means different things in different areas, but I think from the financial sector, liquidity there's sort of two areas where we would look at it in liquidity. One would be where you have vibrant markets, and so the ability, that if you're an investor and you want to buy a security, and the ability to get out of that security if you decide that you no longer want that investment for whatever reason. So having that kind of market liquidity, having a liquid financial market is very important, and that liquidity, the ability to get in and out, provides support for the price of an equity or price of security. So that's important, and that's something the U.S. markets have much better compared to the rest of the world, and actually are another reason, I would argue, why the U.S. economy has done so well coming out of the financial crisis. The other form of liquidity would be looking at bank balance sheet liquidity. And again, while in the crisis there were liquidity issues or perceived liquidity issues with banks, perhaps in some cases more psychological than real, but nonetheless, psychology matters a lot in a financial crisis. You have a situation where banks have built up tremendous amounts of liquidity on their balance sheet. Some might argue too much liquidity being trapped on the balance sheet. But again, the importance of having liquidity is it eases the ability to enter to go in and out of the market, and in doing so, that has a knock-on positive effect on pricing securities.
Final thing, Ken Bensten with us. Ken, let me just ask you this final thing. We've had GDP growth of about 2.2, 2.4%. When Trump was running for president, he said, look, there's no reason why we can't get to 3.5%, even 4% GDP like we had under Reagan. How do we get from where we are 2.5%? How do we get there to 3.5%? What has to happen?
Well, there are a lot smarter economists around than me who are trying to figure out that question. But I will say this: I think what the Trump administration has tried to do is I think they came in and said, the last administration was really focused on fighting the last battle, which was dealing with the financial crisis and coming out of the financial crisis, and that was driving a lot of their policies. And we're going to come in, and our goal is to drive the economy. We want to get it up, to your point, to 3.5% to 4% real GDP growth rate, because we think that should be our most important thing. Is broad economic growth. With broad economic growth, you not only grow the economy, you create jobs, you grow wages and income, and you also, frankly, grow revenue and deal with structural things like structural deficits in the economy. So I think. And I believe what the Trump administration has tried to do in all of their policies is focus on how do we drive economic growth. And while they haven't achieved necessarily the goal they wanted to get to, there's no denying the fact that that's their focus. And they've had pretty good quarters so far. Not maybe what they wanted, but that's their target, and that's how their policies are set.
Ken, what's our risk?
There's always the risk factors that I think economists are concerned about is overheating the economy and sparking inflation. But I think as we look at the, inflation has been pretty tepid and not hitting the targets that the Federal Reserve has set, and the economy has, both in the U.S. and globally, has evolved a lot, over the multiple decades. And thinking back, when I was a graduate student to where we are today, things like capacity utilization of factories is not what it was, right? Because the way the economy operates is so different. You have global trade, you have more developed countries. Besides the U.S. and Western Europe around the world, all that has changed the factors, which I think many economists, maybe not all, believe you can run at a faster clip without the risk of setting off hyperinflation, and that's where that's always been the question of how fast can you run the economy, how hot can you run the economy without the risk of an inflationary situation. To date, it doesn't look like we have that problem.
Well, both of us studied economics, and we have to go back a while. I'm probably older than you are, Ken, but I remember studying the Keynesian curve or something, where it was. Remember, it said where full employment and inflation were mutually incompatible, and as employment went down, inflation had to go up. We've not seen that. So
yeah, that's the old Phillips curve.
The Phillips curve. That was it. The
right.
Phillips curve.
That's right. And yeah, no, I mean, I think that, and actually, there's been a debate about the Phillips curve. Frankly, going back to the late '90s, and
right.
And that it just there was that and the question of Nehru. The natural basically what was there a natural rate of unemployment that you could hit that would then tip the Phillips curve, and then you'd fuel inflation.
Inflation, right?
Right,
And,
but that I mean, those conventions are being severely tested and have been for the last couple of decades.
Yes, and because the theory back then was if you had full employment, people had too much money, and they would drive up the cost of diminishing goods and services. And then I remembered I was in college. I did my thesis, my master's thesis on the Arthur Hafer curve. Remember that, where he said if you cut taxes, revenue goes up. True during the Reagan tax cut, not true during this tax cut as of now. Revenues have gone down. So hopefully that will catch up as we go forward.
Yeah, I mean, it'll be interesting to see. Again, we're early days still. It takes, as you always have to sort of look back on when you get data in, on economic data and even budget data. So, we'll see where we're at.
All right, I want to thank you, Ken Bensten, President CEO of SIFMA, for being with us today and for that insight, sir. Thank you.
Great. Thank you for having me.